Hey everybody, it's Jack, and it's that time of the week again where we're going to be going over my weekly portfolio update video. In today's video, I'll break down the stock market in the week that was. I'll go over all the stock positions that I added to last week, what was I purchasing, and then we'll go over my weekly watch list for the week ahead and all the stocks that I'm going to be looking to pick up or add to over the coming week. Again, just quickly for anyone who's new to the channel, I'm currently undergoing a Wealthsimple trade challenge where my goal is to bring a $1,000 account up to $100,000 through saving like crazy and smart investing. So each and every week I invest around $200 to $250 into my account to stay consistent and really just dollar cost average into the stock market over time. In this video, I'm also going to touch on the different accounts that you can have as a Canadian when it comes to investing. So your TFSA, your RRSP, as well as your personal account. So I thought it would be interesting to just quickly touch on the strength of each account and potentially what stocks you should look to be holding in each of these different accounts, and kind of just talk about my outlook on it and my strategy for what I will be holding in each one of these separate accounts as a Canadian investor. So first, touching on the stock market last week, again, we saw another pretty strong week for both the US and Canadian stock market as a whole. Both of them were up just over 0.4%. So hopefully everyone's portfolios were in the green. So definitely let us all know down in the comments how your week was last week. Were you in the green? Were you in the red? Let us all know down below. So as far as my account status goes, my account currently sits at $6,085.78. So we were up $23.28 on Friday, 0.38%. And then on the actual week, we had a pretty strong week, being up $40.14, 0.66%, so not too shabby of a week. And then finally, all time, we are now up $66.78, 1.11%, and we'll get into what stocks are holding down the account, which are boosting them up. So before we dive into my portfolio breakdown and what stocks I purchased last week, I wanted to quickly touch on the different account types that you can have here in Canada between the TFSA, the RRSP, and then a personal account. I currently use a personal account for this Wealthsimple challenge because I've already maxed out my TFSA. So first things first, I definitely recommend if you have TFSA room, contribution room in your TFSA, to max that bad boy out because that is tax-free growth on your stock investments. You're not going to be taxed on your dividend income or on the capital appreciation when you buy and sell stocks within your TFSA. So I definitely think that's the top priority, is to max out that TFSA. And then for this challenge, I have a personal account, which I just also opened an RRSP, a retirement savings plan. And the reason for this is you can actually contribute to your RRSP and bring down your taxable income for the year. I just graduated university, so I didn't really have a full-time steady job yet, so I didn't have a purpose to open an RRSP because you can actually pass on and defer adding to your RRSP into later years where your income is in a higher tax bracket, so that you can actually take advantage in those years where you're making more money to bring down your annual income and be taxed less on that income. So I decided to open an RRSP because I actually just got a full-time job last week. I haven't started it yet, but I signed the offer. And now because I'm going to be in a higher tax bracket, because my annual income is going to be higher, I thought it'd be worthwhile to start opening that RRSP and starting to make some contributions to it to bring down my taxable income. And it just so happens that, as I talked about in last week's video, I want to start to boost up my consumer staples sector allocation within my portfolio. And there's actually some of the best consumer staple stocks are actually in the US. They're American stocks. So if you didn't know, there's actually withholding tax in these different accounts if you hold US stocks. So in a TFSA, you actually lose 15% of the dividend income through this withholding tax in a TFSA. In a personal account, I believe it's 30%. So if I were to hold US stocks in the account that I have right now for this challenge, the 30% of the dividend income from a dividend stock would actually be taken from the US as withholding tax. But in an RRSP, because there's actually a tax treaty between the US and Canada, 0% of your dividends will actually be held for withholding tax. So you can actually take advantage of this within an RRSP. So that's kind of why I thought this is the perfect timing. Alrighty, so now diving into my portfolio spreadsheet where I track all of my stock positions, my portfolio breakdown, as well as my passive income from my dividends. Let's first dive into all the stocks that I purchased last week. Last week's primary focus was adding to some of my dividend stock positions that were actually down from when I initially purchased them, so I can dollar cost average in lower. I also sprinkled in a little bit of growth stocks here and there, which we'll touch on. But first, starting it off with the top position, Algonquin Power and Utilities. Last week, we actually purchased 2 shares of Algonquin Power and Utilities early in the week, actually under $19. Algonquin Power then had a great week and actually went up 4 to 5% on the week and it's now sitting at around $19.50. So we did dollar cost average, and we're still down on Algonquin Power, as our average cost is still $20.26, but we have now come back quite a bit over the past week. We were down around 10% on this position. We're now only down 3.95%, as Algonquin Power is one of those great dividend growth stocks that I'm really bullish on long term, as they do have some ties into the renewable sector. The second dividend stock on my list here that I added to last week was TD Bank. I added one share of TD Bank as it did come down a bit on the week, and I picked up a share in the low $87 range, and you can now see that it's currently trading still around that price range, so not a whole lot of movement, but it did come down from the $88 range that it was in last week, and I was able to add one more share, as I do think the banks are going to be raising their dividends. The next stock position that I added to last week was Manulife Financial, ticker symbol MFC, and this has just been one that I've been building up and building up and building up over the past few weeks, adding a share here, adding a share there, wherever I can, just to build up this position and dollar cost average lower, as Manulife Financial has been hit really hard over the past month or so. So just dollar cost averaging into this great dividend growth stock for long-term growth and dividend appreciation. So this one's a no-brainer, and I currently have 12 shares of Manulife Financial, and it makes up 4.9% of my portfolio. So it is a decent size in the portfolio, and kind of in that sweet spot, that 4 to 7% range, where majority of my stocks currently sit. And then in terms of growth stocks last week that I did add 10 more shares to my Greenlane Renewables position, ticker symbol GRN. This is one of the two growth stocks that I'm currently down pretty badly on. You can see that HEO, H2O Innovations, as well as Greenlane Renewables are both down around 20% for me, and really dragging the account down, as without these two positions, my account would be up 5 to 6% from when I started this. However, that is not the case, because these two stock positions, again, are down quite substantially, around that 20% range. However, Greenlane Renewables is one that I'm really not worried about. This is a stock that I see getting to that $3 range over the next year or two, as more and more companies and provinces start to adopt renewable natural gas solutions into their pipelines. So I really think Greenlane Renewables is poised to continue to grow, and they've been seeing really great growth quarter over quarter and over the past year or so. So definitely continuing to pick this one up at these prices. And then finally, the last position that I added to last week is one of my growth ETFs, XIT, which is the Canadian Tech ETF. This holds stocks like your Shopify, Constellation Software, Enghouse Systems, and some really other great Canadian tech stocks. And this ETF is a great way to get exposure to those companies like Shopify without having to fork up thousands of dollars to buy shares in those companies. So this is currently a smaller position in my account. It currently makes up 3.9%. I currently have 5 shares of XIT, and I picked one up last week around the $47 range. So now diving into the dividend tracking and the passive income that I earn from my stock portfolio, we can see that by focusing primarily on dividend stocks last week, we are really able to increase our annual dividends from $153 up to $162. So almost a $10 increase by adding a few dividend stocks last week, as our monthly average for dividend income is now sitting at $13.52. So we're almost getting to the point where we can start to actually purchase more dividend shares every single month through the actual monthly dividend. So now looking at our portfolio breakdown, where we can see the weightings of each stock in our portfolio, each individual position, and how much it takes up in weighting, we can see that by adding to Algonquin Power, we actually boosted it up. It was already the highest position in our account by weight, and it's now even higher at 9.3%. So almost 10% of our account is Algonquin Power and Utilities. Again, this is one that I've been down on and continuously dollar cost averaging into this position, as I do think it has a lot of long-term potential as a great dividend growth stock here in Canada. But again, on average, my stock positions are usually in that 4 to 7% range. I kind of see that as my sweet spot for diversification. And if we now move on to sector allocation, where we can see how much each sector is actually weighted within my portfolio, this is one of my favorite graphs I think that there is here. This is kind of what has been driving some of the decisions making I've been doing towards what stocks to add to, what stocks to maybe stay away from adding to and just let them sit. And this is really because I really want to get diversified across sectors in the stock market and really pick 1 or 2 stocks in each sector that I think are going to be winners long term and really focus on those stocks. So you can see that the renewable sector is still my largest sector, sitting at 16.6%. So I'm not really adding too much there, kind of letting that sit for a bit. Financials has been one that I've really boosted up over the past few weeks. It went from being around 4 to 5% of my portfolio to now being over 12% of the portfolio. So really boosted that one up. And then there's also utilities at 13.9. But what I talked about last week is the consumer goods or consumer staples sector being one that has really great dividend growth stocks and one that I don't really have too much exposure to. You can see that it only makes up 3.3% of my portfolio, and that 3.3% is actually good-natured products, a growth stock, not a dividend stock. So I'm actually going to be focusing on adding at least one new position over the coming week into the consumer staples sector, which I'll get into in my weekly watch list. So definitely stay tuned for that. And then the other sector that I want to boost up is my industrial sector, which sits at 4.4% of my portfolio. Again, I really want to help boost this one up, as there are a lot of great dividend growth stocks in the industrial sector. The only stock I currently have in this sector is Canadian National Railway, one of the major railway players in North America. And the final chart that I have here is my asset allocation chart, which shows you the breakdown between ETF, growth stock, and dividend stocks within my portfolio. So you can see that's currently sitting at 57.1% dividend stocks, 22% ETFs, and 20.9% growth stocks. This is kind of that ideal range like I've been talking about in my previous videos, having growth around 20 to 25, ETF 20 to 25, and dividend the rest. So we're currently sitting at a sweet spot, so nothing to really target or focus on primarily when it comes to asset allocation. So now it comes time for my weekly watch list for the week ahead. And as I mentioned, what's going to be driving my decision making in this week coming up is really just targeting stocks and sectors that I want to bring up in weighting in my portfolio to help get some more well-rounded diversification. So in terms of stocks that I'm targeting for actual appreciation in their share price or growth, the first one is Kirkland Lake Gold, ticker symbol KL. Kirkland Lake Gold is actually my best performing stock to date. It's currently up 25% for me from when I purchased it around a month or two ago in the low $40 range. It's now trading in the low $50 ranges. So I'm really hoping to pick up another share of Kirkland Lake Gold. Hopefully below $51 would be ideal. Again, it's currently trading around $52 in the $52 to $53 range, as this is a stock that is not only a premium gold miner here in Canada, but it's also a great hedge against inflation. Again, the May numbers just came out for inflation, and it seems like inflation is continuing to rise. So Kirkland Lake Gold is kind of a win-win because it's a gold mining stock, which will directly go up if the price of gold goes up due to inflation. And again, this is just a really premium gold mining company that I would like to own even if it wasn't a hedge against inflation. And then the second stock that I'm going to be purchasing for growth is Canadian National Railway, ticker symbol CNR. This is one that has been trading kind of sideways over the past few weeks in that kind of $135 to $130 range. I'm looking to add my third share of Canadian National Railway, hopefully below $132. Ideally, I would like this one closer to $130 because it is kind of trading at a little bit of a higher premium in terms of its PE ratio. However, I do think because of the acquisition of Kansas City Southern, this is just a no-brainer moving forward for the next decade or so to hold. This also is in the industrial sector, which I'm trying to bring up in weighting in my portfolio. And in terms of dividend stocks or ETFs that I'm planning to add next week, the Canadian Dividend ETF is top of the list, VDY. This is one that I recommend for any Canadian to hold. This is an ETF that holds all of the top Canadian dividend stocks within it, and it pays a monthly dividend. So I like to continuously add 1 or 2 shares every single month to this position and really help build up that monthly dividend income. So definitely looking to pick up one more share at least of VDY next week. And finally, the last stock that I'm looking to add in the week to come is actually PepsiCo. So this is one that I featured and talked about in last week's video when I was talking about different stocks within the consumer staples sector that I was potentially looking to add to my portfolio. There's some in the Canadian, such as Metro or Loblaws. However, I decided to go with PepsiCo because I see PepsiCo as a really great long-term play that I can hold in my brand new RRSP. PepsiCo as a company is one that pays around a 3% dividend, and it's actually been growing its dividend for 49 years straight. So it's 1 year away from being a dividend king, which is raising its dividend for 50 years straight. And in terms of why I decided to go with PepsiCo, again, one, it's that dividend growth streak of 49 years, which is huge. And secondly, it's all of these sub-brands that actually fall under PepsiCo. We're talking billion-dollar brands that PepsiCo owns, such as Gatorade, Doritos, Lay's, Mountain Dew, the Pepsi drinks themselves. So there's actually a lot of diversification in the sub-brands that PepsiCo owns. And again, I think all of these are going to help drive them moving forward to better growth and continuing that dividend growth streak. So PepsiCo is one that I think is going to be a really great option in my RRSP to hold for, decades into the future. And that is my weekly watch list for the week ahead. So there you have it. That was my weekly watch list for the week ahead, what stocks I'm looking to add to in the coming week. So I hope you guys enjoyed this video. As usual, smash that like button if you did. It really means a lot to the channel. And subscribe if you aren't already. Lots more content coming your way. I'll see ya in the next one.